Good day to you all. Welcome to another video class. In today's class, we'll be treating basis of accounting and bookkeeping. So if this is your first time on this YouTube channel, click the red button. As you can see, there's always a red button below this video. Click the red button to subscribe so you can get more and more of our videos. So before we go into the class, just wait. Don't believe you know what is about to be taught in this video, because after this video you will have a mind blowing. So take your time, sit down, get your writing materials as we proceed in our class. Now welcome back. So before I actually go to what the meaning of accounting and bookkeeping, let me quickly tell you a story of a young man called Luca Pacioli. There was a young man called Luca Pacioli. The story I'm about to tell you happens in the year 1494 rather. So it happened in the year 1494. So this man, Luca Pacioli, was regarded as the father of accounting. The question is why? Why was this man regarded as the father of accounting? Now fine. In the year 1494, this man wrote a book, and a title to the book, Summa the Geometrical Arithmetic Proportion et Proportionality. Let me write it on the board so you will see. Summa the Geometrical Arithmetic Proportion et Proportionality. So imagine the name of a single book written by a French accountant is as long as this. This is the name of the book, Summa the Geometrical Arithmetic Proportion et Proportionality. So when this man wrote this book, though it has been believed that years before this man, Luca Pacioli, wrote the book, there has been accounting transactions, because right from the day the world has started, there has been calculations, there has been exchange, there has been buying and selling. So but there have been accounting has been established then, but it was a principle originated from this man, Luca Pacioli. It's a general principle that we all use today. It's called the principle of double entry. The principle of double entry. Now, it was in this book, don't forget I said earlier that this man wrote a book which he titled Summa the Geometrical Arithmetic Proportion et Proportionality. It was in one of the chapters of this book, this man explained the principle of double entry. I'm going to emphasize on that before I proceed to what accounting and bookkeeping is. That's why Luca Pacioli is regarded towards the father of accounting. Anywhere they ask you who is the father of accounting, Luca Pacioli. Why? Because he wrote a book entitled Summa the Geometrical Arithmetic Proportion et Proportionality, and in this book he explained the principle we have been using up till date, which is the principle of double entry. Now let's now see what is this. What does the principle of double entry state? Because it is the foundation for everything you want to learn in accounting. Everything you want to know in accounting is the foundation for it. So let's establish and let's explain what we mean by the principle of double entry. So let's proceed. So what does the rule of double entry state? The rule of double entry states that for every debit entry, there must be a corresponding credit entry, and vice versa. For every debit entry, there must be a corresponding credit entry, and vice versa. Now, in every book of accounting, we always have two sides. We always have the debit side, and we always have the credit side. Now, what was this man trying to explain? In accounting, we believe that debit is the receiver, and credit is the giver. Though we have some exceptions to this rule, but majorly we believe that debit is the receiver and credit the giver. What do I mean by debit the receiver and credit the giver? That means in any transaction, when we are receiving money, we debit it. For example, now, Shade paid the company 6,000 naira. Shade paid the company 6,000 naira. Now, this we are receiving this 6,000 naira from Shade, so we are going to debit it here. Shade 6,000 naira. That's what we mean by debit the receiver and credit the giver. And if money is going outside of the organization, we credit it. For example, we paid wages 7,500. So we paid wages 7,500. Here money is going out of the organization, so we are going to credit it. Wages, how much? 7,500. So the principle of double entry will be explained further, but let me just explain this to you guys, that why was this man actually regarded as the father of accounting? Because of this simple thing he just propound. Why? Let's take it this way. So this principle of double entry is trying to tell us that in every transaction, number one, in every transaction that two people are involved, this rule of double entry that is up here. So two people are involved. What do you mean by two people are involved? For example, now this is Mr. A, this is Mr. B. Mr. A and Mr. B. Mr. A, Mr. B. Now, Mr. A bought pencil from Mr. B. Mr. A bought pencil from Mr. B. So, Mr. A is giving out the money. Money is going out, and pencil is coming in. So, money is going to Mr. B. Pencil is coming to Mr. A. And in accounting, we don't deal with goods, we deal with money. Where the money is going to, that's what we are concerned with. We are concerned with where the money is going to, not where the goods is going to. So we are concerned with where this money is going to. So as a matter of fact, you can say that the money is going to Mr. B. So therefore, Mr. B will debit his account, Mr. A will credit his account. So Mr. B will debit his account. So that is what this rule of double entry is trying to say, that for every debit entry, it's trying to say that whenever we have any transaction to happen and there is debit entry, definitely there will be a corresponding credit entry. So now in this transaction that we just analyzed below here, now in this transaction we have here, we have a debit entry here. Is it possible for us to debit Mr. B's account and then at the same time debit Mr. A account? No. So that is what the rule of double entry is saying, that if one account is debiting, other will be crediting. Because for every transaction, it is at least we need two people to be involved in every transaction. It's not possible for Mr. A to buy from himself, sell to himself, eat all by himself. It's not possible. So at least for every transaction, two people are involved. And in this transaction, so look at Pakeli is now trying to say that in every transaction, one person must be the debit and the other person cannot be the debit again, but the person will be the credit. So that's what he's trying to say, that whenever we have a debit entry, there must also be a corresponding credit entry. Let me play a better scenario so you will understand this better. So let's proceed. Look at what we have here. We have Tolu sold 500 naira goods to Matthew. Tolu sold 500 naira goods to Matthew. Now let's open Tolu's account and let's open Matthew's account. So let's say this is Tolu's account, this is Matthew's account. Now the question you need to ask yourself is that who is receiving the money here, who is giving? Since Tolu is selling, Tolu is giving out the goods and Tolu is receiving the money. So Tolu account will be debited, right? 500 naira debited. And if Tolu account will be debited, that means Tolu received the money. So is it possible for Tolu and Matthew to engage in transaction and they will both receive money? It's not possible. One person will be giving out the money, one person will be giving out the goods. So for every debit entry that we have here, there is debit entry here. So in the next account, you don't need to start chasing. You should know that the next account will be credited. That's what the rule of double entry is saying, that So in a nutshell, it says that since debit is the receiver, another name for debit, don't forget I said that debit is the receiver and credit is the giver. So since debit is the receiver, so for every receiver, just change it, for every receiver there must be a corresponding giver. That is what it's trying to say, that for every debit entry, and debit, we know that debit is receiving, there must be a corresponding credit. So for every giver there must be a for every receiver debit, there must be a corresponding giver. That's what it's trying to say. So Tolu has received the money 500 naira. It's not possible for us to debit Matthew's account as we have just debit Tolu's account. No. So Matthew's account will be what? Credited. So this principle, in most of the accounts you want to prepare, you usually use the principle of double entry. That for every debit entry, there must be a corresponding credit entry. So whenever you are preparing any account and you have two accounts to be opened, you've opened the first one, and the first one you need to credit it. Just know that the second one will be what? Debited, because in every transaction it's not possible for you to receive, for one person to both receive money and do transaction. It's not possible. So one is receiving, the other is what? Giving. That's what he's trying to say, that for every debit entry there must be a corresponding credit entry. So let's now go, what is really accounting, what is accounting, what is bookkeeping? Let's check out what they both mean. Now, clearly times without number, when we read our accounting textbook, most time we find it hard to differentiate between bookkeeping and accounting. Now, yes, it's different between bookkeeping and accounting. So we have, while bookkeeping is the recording and classifying of business transactions, accounting makes use of the recorded and classified information and present them in a way that will fascinate or draw investors' interest. Now, what do we mean by this definition? Now, what is bookkeeping? Bookkeeping is a small aspect of accounting. Bookkeeping deals with, just as the name has imply, bookkeeping, which also means what? Keeping book. Now, for example, now we need to keep day-to-day transactions in an organization. There's no how you have a big organization that you must not keep day-to-day transaction. For example, now keeping day-to-day transaction means we have a book where we record all transactions that happened in a month or so. For example, now let's say this is my book of record, that I record every transaction that happened. For example, so what is bookkeeping? I'm still on bookkeeping this time around. So let's say January 1, Mr. A purchased 3,000 goods. Mr. A purchased 3,000 goods. I'll come to my books, I will record it that January 1, Mr. A purchased 3,000 goods. January 3, Mr. B sold 7,500 goods to us. So January 3, Mrs. B sold 7,500 goods to us. So what am I doing? I'm recording day-to-day transactions. That is bookkeeping. Bookkeeping deals with recording day-to-day transactions, everything that happens on a day-to-day transactions. So though we don't record irrelevant things, there's a concept in accounting that is called the materialities, money measurement rather. It is called money measurement. So money measurement is trying to say that anything that doesn't deal with the inflow and outflow of money, we shouldn't record them in our book of transactions. And that's true, because if the manager of an organization is having headache, you can never see it in our book of accounts, because it doesn't affect the inflow and outflow of money. So but anything that affects the inflow and outflow of money, we must keep day-to-day record. So the art of keeping the books, keeping necessary transactions, is what we call bookkeeping. So that's why, as you can see here, while bookkeeping is the recording and classifying of business transactions, bookkeeping is just the recording, and you classify of what? Business transactions. Questions I can ask you is that, where do bookkeeping stop? Bookkeeping stop when you prepare trial balance. Now, after you have your trial balance will be further used to prepare what? Trading, profit and loss, or any other account you want to be given. So the work of a bookkeeper ends when the trial balance has been prepared. So We now use the trial balance to prepare further accounts. Account like trading profit and loss, account like partnership, account like single entry. So all these are work of an accountant. A bookkeeper is just to keep day-to-day record. In fact, anybody can be a bookkeeper. If I should have a small shop and I employ an undergraduate to come and run or manage my POS business, so the undergraduate there is a bookkeeper. Why? Because he or she will keep the proper record of everything that's happening in the business every day. So she's a bookkeeper. But if I now need the work of an accountant will now help me to prepare, analyze my information that the bookkeeper has recorded. Then that is the difference between what bookkeeping and accounting. While bookkeeping is the recording and classifying of business transactions, accounting makes use of the recorded. Accounting now makes use of the recorded classified information. So everything you've recorded, accountants will now make use of it to prepare further accounts so that you can attract the interest of shareholders, those that will invest in your business, the interest of investors, the interest of different things like that. So that's the work of an accountant. It's different from bookkeeping. Bookkeeping is just the day-to-day recording of transactions. Accounting deals with it. Accounting is more than that. Deals with, makes use of the recorded and classified information and present them. So it makes use of this information and present them in a way that will fascinate or draw the interest or draw investors' interest. Because as an investor, if you want to invest your money in any business, you have to see their book of accounts. So what we mean by their book of accounts is not the day-to-day transaction, is what the financial accountant has kept as a record. So that's the difference between what bookkeeping and accounting. So let's proceed, guys. We now want to move toward the scope or types of accounting. So in every organization, we have different types of accountants. So the first one I'll be explaining is what we call a financial accounting or financial accountant. Financial accounting. So who is a financial accountant? So let's go. Financial accounting is the process of what? Preparing the final. Let's write it on the board. Financial accounting is an financial accounting. So now financial accounting is an aspect of accounting. Financial accounting is an aspect of accounting that deals with the preparation and interpretation of recorded information. What do you mean by a financial accountant? Who is a financial accountant? Just like I said earlier, I said in every organization we need a bookkeeper. A bookkeeper keep proper records of all transactions. Now there are those that now prepare, those that interpret what the bookkeeper has recorded. They are called financial accounting. For example, like let's say this is the book of account that the bookkeeper has prepared and it needs to be interpreted. So those that prepare the final accounts that interpret it are called financial accountants. They are called financial accountants. Their own is just to prepare and interpret what the bookkeeper has recorded. So there are some that need to prepare at the end of the year, like organizations like trading profit and loss is always yearly, manufacturing is always yearly, and so on and so forth. So all these are yearly accounts that will be prepared. So but before it can be prepared, we need books that contain all the transaction that has happened, which will be kept by the bookkeeper. So a financial accounting or a financial accountant interpret what the bookkeeper has recorded so far. That's who a financial accountant or financial accounting is all about. So let's go. Another one is what? Cost accounting. So as I've said here, cost accounting deals with accumulation of data to formulate policy. So this cost accounting just deals with everything that pertains to costs. So for example, now we can have, let me give us an illustration. We can have two different markets with different prices of goods. So it is the work of a cost accountant to determine the value and the price of the product here. If the value of the product here, value is not measurable like that, but let's assume the value of the product here is 20 and the price is 100, and the value of the product here is 30 and the price is just 80. So which one do you think the cost accountant will go for? They will go for this. Why? Because they will try to minimize their costs. That because this one here has a very high quality, even more than this, and the price is low compared to this. So that's why cost accountant just makes information. They research more on costs, so to reduce the cost of production of any organization. So that's what cost accounting deals with, or is all about. So what do we mean? The next one is an auditor. So auditors are people who examine the financial statement prepared by the financial accountant to ensure a fair presentation. So who is an auditor? Don't forget I said that a financial accountant is the one who take everything that has been prepared by the bookkeeper and interpret it in a way that will make investors to be interested in the organizations. But the question is, what if this financial accountant did not represent or did not prepare it in a way it should be? For example, now let's say the worth of an organization is 5,000 naira, but this financial accountant has written that the worth of the organization is 100,000 naira. This is not a true representation of the organization. This is not a true representation of the organization. So there is need for an auditor to audit the financial statement of an organization to be sure if what this financial accountant has written so far is true. So that's who auditors are. They are the ones that examine the financial statement prepared by the financial accountant to ensure a fair presentation. So the work of an auditor can be once in 3 years, once in 4 years, or once in 5 years, based on if they want to interpret or check what the financial accountant has written so far, maybe it's true or not. So let's look at the last one, which is called the forensic accounting. So of it all, we have what we call forensic accounting. So this refers to application of accounting skills to detect and probe frauds. It's as straightforward as something very simple. So a forensic accountant is someone who detects fraud. Someone who check if the financial accountant and the auditor has both planned or they have engaged in one thing or embezzle the company funds. So that's where a forensic accountant is. A forensic accountant check all the financial statements, investigate and prove everything to see if there is nothing like fraudulent activities. So we have come to the end of today's class. If you have really enjoyed the video, please, there's a red button here. Click the red button. It's a subscription button. Subscription is free. And on the notification button, so that when we drop our next video, you will get notified. Thank you. I remain your amiable teacher. See you in our next class.